An industry leader ignores a new, disruptive technology that makes their core profit driver free or near zero cost, believing their scale will save them. Proof. Kodak ignored digital. Nokia ignored Smart OS. Blockbuster ignored Netflix Talk Mail. Prophecy. Mapping the slow death of traditional banking, massive physical footprint, high fees, against the rise of decentralized finance, stablecoins, and instant free payment rails, showing the inevitability of the banking system being bypassed and made irrelevant. Section 1. The Curse of the Core. Business. Defining the adjacent zero. The history of modern capitalism is not a story of seamless progress. It is a graveyard of giants. From the railroads to the mainframes, from the encyclopedias to the film processors, market leaders, companies that enjoyed decades of unparalleled dominance, profit, and scale, have been systematically annihilated not by direct competition, but by ignoring a change in the fundamental physics of their business. This failure is not a failure of innovation. It is a failure of organizational vision, what we define as the Blockbuster Blindness Pattern. The pattern begins when an industry leader, intoxicated by the success and profitability of its core business model, dismisses a nascent, often clumsy technology because that technology lives at the adjacent zero. The adjacent zero is a disruptive technological vector that renders the incumbent's most profitable, most established, and most necessary revenue source free or near zero cost. For decades, Blockbuster's core profit was derived from late fees. The business model was built on friction and penalty. Netflix's initial model, mailing DVDs, made the late fee zero. Kodak's core profit was derived from chemical film processing and printing. Digital photography made the chemical process zero and the print optional. Nokia AS core profit was derived from selling proprietary hardware and operating systems based on limited features and voice calls. The iPhone, leveraging open source components and cheap data, made the functional cost of a phone's software and its communication services near zero. The common thread across all these colossal failures is the incumbent's rational defense of irrational profits. They didn't lack the technology. Kodak invented the digital camera. They lacked the organizational metabolism to destroy their own golden goose. A $1 billion a year late fee business looks incredibly robust next to a clumsy, slow mail order DVD service. A 90% gross margin on film processing looks bulletproof compared to the fuzzy, low resolution images of the first digital sensors. The internal logic of the incumbent always dictates the wrong choice. Discount the threat. It's too small, too niche, too low quality, too slow. Blockbuster on streaming bandwidth, Kodak on digital resolution. Rationalize the core. Our infrastructure is too massive to be replicated. Our brand is too strong, and our switching costs are too high. Optimize the dying model. Instead of pivoting, the incumbent doubles down on optimizing the existing profit driver, pouring resources into making the horse faster instead of buying a car. This is the fatal stage. The core paradox is that the Blockbuster blindness is a function of success, not failure. The company is too rich, too big, and too internally structured around a cash cow to pivot to a model where that cow is extinct. The internal metrics, profit per unit, return on existing assets, scream, stay the course, even as the external technological landscape whispers, the rules have changed. This phenomenon is not isolated to media or technology. It is a universal pattern of industrial displacement. It is the economic equivalent of a slow-moving but unstoppable tectonic shift. The incumbent always confuses their scale, the size of their army, with their relevance, the strategic value of their weapons. When the technology at the adjacent zero reaches a critical inflection point, when the digital resolution is good enough, when the streaming quality is reliable, when the decentralized payment rail becomes instantaneous, the giant falls in a matter of quarters, not decades. The entire core value proposition is rendered null. This is the pattern we must now apply to the oldest and most entrenched giant of all, traditional banking. Section 2, the Blockbuster banking model. The core, profit driver, and its fatal friction. To understand the prophecy of the Blockbuster blindness applied to the financial sector, we must first dissect the core profit driver of traditional commercial banking, the very thing that the adjacent zero is poised to render obsolete. The modern banking system, dominated by giants like J.P. Morgan Chase, Bank of America, and Wells Fargo, is built on friction, time, and physical infrastructure. These elements, which were once indispensable and represented value, are now the core business's fatal vulnerabilities. The two most profitable friction points in the legacy banking model are the physical footprint and overhead. Banks maintain massive networks of branches, ATMs, data centers running decades-old mainframe systems, and hundreds of thousands of employees, all of which generate enormous overhead. This overhead is not absorbed by the bank. It is passed directly to the customer in the form of high fees, low interest rates on savings, and large spreads on loans. The branch network, once a competitive advantage, is now a multi-billion-dollar-a-year liability that a digital native competitor simply does not have. The payment and transfer system, intermediation. Every wire transfer, ACH payment, cross-border remittance, and credit card transaction involves a complex, multi-day, multi-party process, SWIFT, Visa, MasterCard, Fedwire, that allows the bank to act as the necessary intermediary. The bank's primary job is to guarantee trust, manage liquidity, and hold customer funds overnight. This intermediation allows them to skim fees, hold capital captive, and earn interest on funds that are temporarily in transit or sitting idle, the very essence of their profit. These two profit drivers rely entirely on the fact that money movement and custody are expensive, slow, and non-transparent. The bank's scale and regulatory moat have historically protected this friction, allowing them to dismiss smaller, nimbler competitors. The initial response from traditional banking to early digital disruption perfectly followed the Blockbuster Blindness Pattern. Discount the threat, early internet. Banks viewed early online banking as merely a cheaper delivery mechanism for their existing products, checking accounts, mortgages. They never saw the internet as a tool to change the nature of money itself. Rationalize the core, 2008 crisis. Following the 2008 financial crisis, banks believed increased regulation, Dodd-Frank, strengthened their moat by imposing capital and compliance burdens that only giant institutions could bear. They confused regulatory stability with technological relevance. They believed their scale and their too-big-to-fail status made them immune to creative destruction. Optimize the dying model. Banks spent billions digitizing paper forms, creating better mobile apps, and closing underperforming branches, all efforts to make the existing friction-based product slightly less painful, rather than pivoting to a frictionless model. They focused on digital transformation of the branch, not elimination of the branch model. But the real threat, the adjacent zero, was not coming from other banks or even traditional fintech firms. It was being built entirely outside their regulatory and technological purview, leveraging the very open, decentralized principles that banks instinctively despise. The emergence of cryptocurrency, decentralized finance, DeFi, and stablecoins represents the tectonic shift that will ultimately destroy the banking model's core value proposition: expensive trust. The prophecy is that the financial system will be bypassed, not defeated. Once custody and money movement become instant, globally available, transparent, and essentially free, the bank's core function, the role of the expensive intermediary, is rendered entirely redundant. They will be left holding a massive, expensive physical footprint with no profitable service to offer. The giant will awaken to find the battlefield has moved to a dimension where its size is meaningless. Section 3, the adjacent zero: decentralization, stablecoins, and the death of intermediation. The adjacent zero for the banking industry is defined by the confluence of three key technologies that attack the core profit drivers of friction and intermediation: blockchain, decentralized networks, stablecoins, and instant payment rails. 1. Blockchain and decentralization, the new trust model. The invention of Bitcoin and subsequent public blockchains demonstrated that trust in a financial transaction could be established cryptographically and algorithmically across a distributed network, rather than relying on a centralized, regulated, and expensive third-party intermediary, the bank. Core attack. The bank's most valuable asset is its function as the trusted ledger keeper. Decentralized ledgers eliminate the scarcity of this trust. They make ledger keeping ubiquitous, transparent, and auditable by anyone, anytime. Cost impact. Transferring value across a decentralized network, though sometimes incurring transaction fees or gas, is often orders of magnitude cheaper than cross-border wire transfers, credit card interchange fees, or managing bank capital requirements. The cost of guaranteeing security and settlement, once borne by the bank's overhead, is distributed and automated. 2. Stablecoins, the currency of the adjacent zero. Early cryptocurrency volatility was a legitimate barrier to mass adoption. Stablecoins, digital tokens pegged 1.1 to a stable asset like the US dollar, solved this problem. Tokens like USDC and USDT are digital dollars that live entirely on a public blockchain. Core attack. Stablecoins directly attack the bank's checking account and payment rail business. They allow individuals and corporations to hold dollar value that is instantly transferable globally, 24/7, without requiring a bank account, an ACH clearance, or the SWIFT network. Friction elimination. Sending $10,000 from New York to Singapore via a bank can take 1 to 5 days, cost $30, $70 in fees, and involves correspondent banks, time zones, and compliance bottlenecks. Sending the same $10,000 via a stablecoin takes 5 seconds, costs cents, and requires only 2 wallets, completely bypassing the entire legacy correspondent banking system. The time and cost of movement approach zero. 3. Instant payment rails, the final inflection point. Traditional payment rails, ACH, Fedwire, operate only during banking hours and rely on batch processing. Decentralized networks operate 24/7, 365, settling transactions instantly and permanently. The banking paradox. Banks are trying to catch up by building their own instant payment systems, like FedNow in the US. But these systems, while faster, are still centralized, regulated, and inherently limited by the legacy overhead, branches, compliance, old code, that the bank must still maintain. The decentralized competitors do not carry this baggage. The power shift. Once a business can pay its vendors, suppliers, and employees instantly, globally, for near zero cost using a stablecoin, the entire purpose of maintaining a high-fee, slow-moving commercial bank account and the liquidity it holds evaporates. The money will move onto the decentralized rails where the speed and efficiency live. The blockbuster blindness is manifesting as banks focus on minimizing the loss of their core business, e.g., charging higher overdraft fees to offset declining interchange income, rather than pivoting to a new model. They see Bitcoin as a volatile asset, a niche investment, and stablecoins as a compliance headache, rather than recognizing them as protocol updates for money itself. They are staring directly at the adjacent zero, instant, free, global financial transfer, and dismissing it as an unregulated hobby. The collapse is no longer a possibility. It is a mathematical inevitability driven by superior technology making the incumbent's core service technologically redundant. Section 4. The prophecy. Unfolding, mapping the death of banking's core segments. The death of traditional banking will not be uniform. It will be a staged cannibalization, beginning with the segments where friction and high fees are most acute, perfectly mirroring how digital photography first displaced amateur film before killing professional film. We can map the staged assault of the adjacent zero onto the three most profitable segments of the legacy banking model. 1. Cross-border payments and remittances, the immediate collapse. Legacy fee structure. This segment relies on the expensive SWIFT network, correspondent bank fees, and currency conversion spreads. Typical fees range from 2% to 10% of the transaction value. Adjacent zero attack. Stablecoins and decentralized rails, e.g. Ripple, specialized DeFi protocols, offer transactions at a fraction of a percent, near zero. Prophecy outcome? This segment is already collapsing. Fintech companies and crypto platforms are handling an exponentially growing volume of cross-border transfers and remittances. Banks will be relegated to the highest-end regulated sovereign transfers, but the lucrative retail and SME cross-border business will be entirely lost to crypto rails within the next decade. The bank's only remaining role is to act as the on-off ramp between the fiat system and the stablecoin rail, a low-margin, regulatory-intensive service. 2. Lending and credit, the disintermediation of capital. Legacy fee structure. Banks profit by being the mandatory middleman between savers, depositors, and borrowers, loan recipients, profiting from the interest rate spread. This requires massive capital reserves and regulatory overhead. Adjacent zero attack. Decentralized finance, DeFi. Platforms allow peer-to-peer lending and borrowing, often over-collateralized initially but rapidly maturing, using smart contracts. Savers can earn much higher yields, often 4% to 8% instantly, than a bank offers because there is no intermediary overhead. Borrowers can access capital directly, collateralized by digital assets. Prophecy outcome. While retail mortgages and secured loans, e.g. auto loans, are difficult to displace due to legal and collateral infrastructure, the profitable, high-yield segments of corporate and institutional lending are already under threat. Capital markets are moving on-chain. The bank's ability to arbitrarily set interest rates and capture the spread is eroding as liquidity becomes global, decentralized, and transparent. The lending function will be fragmented, with banks only retaining the highest-risk, legally complex segments that require traditional legal enforcement. 3. Custody and treasury management, the final blow. Legacy fee structure. Banks hold trillions in corporate and retail checking accounts, earning interest on that capital, float, and charging fees for basic treasury services and account management. This is the bedrock of their balance sheet. Adjacent zero attack. Tokenized real-world assets, RWAs, and advanced stablecoin protocols allow corporations and high-net-worth individuals to hold capital in digital wallets that are instantly transferable and can simultaneously earn yield on DeFi protocols. The digital wallet becomes the checking account, the savings account, and the transfer mechanism all at once. Prophecy. Outcome? The bank's balance sheet will shrink. Why would a corporation hold idle billions in a zero-interest bank account when they can hold it in a stablecoin and earn 4% yield while maintaining 24/7 instant transferability? The custody of capital, the bank's core identity, will become a consumer choice managed by private keys and self-custody or third-party digital custodians, not centralized banks. This is the Kodak moment for the balance sheet. Once the money leaves the deposit base, the bank loses its ability to lend and its primary source of float revenue. The bank becomes a shell, operating only at the margins of regulatory arbitrage. The blockbuster blindness prevents banks from seeing that they are being replaced not by a new competitor, but by a new protocol. You don't innovate your way out of a protocol change. You adopt or die. Section 5. The incumbent's final defenses, regulatory moats, and the illusion of safety. Faced with the mathematical inevitability of the adjacent zero, traditional banking is employing the classic defensive maneuvers of the entrenched incumbent, relying on its two remaining advantages, the regulatory moat and the illusion of safety. However, these defenses are proving to be temporary shields, not permanent fortresses. 1. The regulatory moat, the political lifeline. Banks actively lobby governments to classify decentralized finance as inherently risky, illegal, or a haven for money laundering. Their goal is not to compete with the adjacent zero, but to outlaw it. This strategy aims to leverage the state's power to enforce technological inferiority. The bank's argument: we are the only system that ensures AML KYC compliance. Unregulated crypto threatens national security and consumer safety. The reality: regulation protects the incumbent's revenue model, not necessarily the consumer. While AML KYC are necessary, banks overlook that most decentralized networks are inherently more transparent than the current opaque correspondent banking system, SWIFT. The movement of funds is visible on a public ledger. Regulation is a powerful moat, but it only works until the cost of maintaining that moat, compliance, bureaucracy, exceeds the cost of simply bypassing it entirely. As DeFi and stablecoins mature and voluntarily adopt compliance standards, the bank's primary regulatory argument weakens. 2. The illusion of safety, the FDIC comfort blanket. Banks leverage government deposit insurance, FDIC in the US, to convey an illusion of guaranteed safety that decentralized networks cannot legally offer. This acts as a powerful psychological barrier for the average retail consumer. The bank's argument: your money is safe here, guaranteed by the government, crypto is risky. The reality: this safety guarantee comes at the cost of zero interest and zero efficiency. When inflation is high, the guaranteed safety of the FDIC checkmark is offset by the guaranteed loss of purchasing power from stagnant yields. Furthermore, the illusion of safety only extends to the retail customer. Large corporate treasuries and institutional funds, which represent the bulk of the banking balance sheet, are often uninsured and are the first to seek higher yield, more efficient stablecoin solutions. The illusion of safety works on the individual depositor, but it fails against the rational self-interest of the institutional capital that the bank relies upon. 3. The embrace of blockchain, not Bitcoin, the fatal compromise. In a final desperate move, banks have attempted the Nokia strategy: build their own closed, permissioned versions of the competing technology. They embrace the underlying blockchain technology for internal efficiency, but reject the decentralized, open, zero-friction protocol that drives the disruption. The strategy: build JPM coin or internal settlement networks. Use blockchain to make their internal transactions faster. The failure: this solves the bank's internal problems, but fails to address the consumer as external need for global, permissionless, instant value transfer. The bank's solution remains closed, centralized, and subject to their overhead and banking hours. It is an attempt to put the late fee back into the mail-order DVD service. The market is not interested in a faster version of the old paradigm. It has moved to the completely new open protocol. The blockbuster blindness dictates that the incumbent will fight the technological change using non-technological tools: regulation, lobbying, historical trust. This delays the inevitable collapse, but also ensures the collapse is more complete when it finally arrives, as the bank has wasted the final years of its relevance fighting a regulatory war instead of building a new, zero-friction business. The moment a fully regulated, globally adopted stablecoin becomes the dominant transfer mechanism, the regulatory moat will become a regulatory cage, trapping the incumbents while the rest of the financial world moves on. Section 6. The post-banking economy, the new financial physics, and the end of intermediation. The culmination of the blockbuster blindness pattern in finance is the emergence of the post-banking economy, a system defined by its speed, transparency, and lack of expensive intermediaries. This is the financial equivalent of the shift from the closed, proprietary systems of the 20th century to the open, permissionless protocols of the internet. The post-banking economy is built on these foundational shifts. Money as information, the protocol shift. Money is no longer a physical or centralized IOU managed by a bank. It is an immutable, self-executing data packet traveling on a public network. Its movement is instantaneous and borderless. This eliminates the role of the slow, costly correspondent banking system entirely. Credit without centralization, the capital market shift. Lending and borrowing will be facilitated by smart contracts and decentralized protocols that manage collateral and interest transparently. The massive capital reserves and balance sheet management that define the 20th century bank will be replaced by algorithmic governance and distributed liquidity pools. Banks will transition from being principals, lending their own money, to being agents, advisors, and custodians in a decentralized market, a massive decline in their profitability and systemic importance. Custody without conflict, the wallet shift. The core responsibility for capital custody will devolve back to the individual, self-custody, or to highly specialized, regulated digital custodians that offer superior security and efficiency without the bank's massive overhead. The bank branch, the ATM, and the call center, the expensive infrastructure of trust, will become financially indefensible relics. The blockbuster blindness applied to banking is the failure to recognize that speed and zero-cost movement are now table stakes. Once the customer experiences the instant 24/7 global settlement of stablecoins, they will never tolerate the 3-day ACH hold or the $50 wire transfer fee again. The perceived value of the bank's brand and physical presence is not enough to offset the superior utility of the adjacent zero protocol. The eventual fate of the legacy banking giants will be one of two paths. The Kodak path, total collapse. The institution remains rigidly committed to its high-friction business model, fighting regulatory wars until the majority of profitable deposit and transfer volumes have left its balance sheet. It becomes a small, heavily regulated utility service that handles only the lowest margin domestic consumer accounts, unable to sustain its massive overhead, ultimately failing or being absorbed at a fraction of its former value. The IBM path, painful pivot. The institution uses its regulatory expertise and existing client base to become a specialized on-off-ramp provider and a digital asset custodian for the decentralized economy. They stop acting as the intermediary and start acting as the secure, insured gateway to the zero-friction rails, leveraging their remaining regulatory status to provide services the decentralized world cannot. This is a survival strategy, not a return to dominance. The profits will be a fraction of the former interest rate spreads, and the systemic importance will be dramatically reduced. The lesson of the blockbuster blindness is always the same. The technology that makes your core profit free will destroy you. The massive physical footprint, the slow centralized systems, and the friction-based fee structure of traditional banking are all incompatible with the new financial physics of instant, transparent, near-zero cost value transfer. The giants of the 20th century financial system are staring directly into the adjacent zero, and the prophecy of their irrelevance is being settled algorithmically, one stablecoin transaction at a time. The financial system will be bypassed, and the age of the expensive intermediary will come to an end.